For our group presentation, the two companies we decided to research on and analyze were L Brands and Nordstrom. In our presentation, we did the research based on the industry as a whole, which has been defined by the COVID-19. And the timeline that was focused on was during 2019 to 2020. There were shifts, trend towards, depending on the brand, like within L Brands, Victoria's Secret, the shift was towards body positivity. There were changing trends more on leisure and casual wear due to COVID for people working remote. There was also a shift in market from majority baby boomers to millennials. And then there's also a shift in marketing and retail as it moves towards online and digital outreach. And then we'll also go over that there's a decline in shopping at the physical mall due to the online shopping.
So beginning with L Brands Inc. operates a specialty retail business. The company is focused on women's intimate and other apparel, personal care, beauty, and home fragrance categories. It sells merchandise through company-owned specialty retail stores in the United States, Canada, the UK, and Greater China, which are all mall-based, also through websites and through international franchise, license, and wholesale partners. L Brands got its start in 1963 with the opening of the limited clothing store. The name came from an idea to limit merchandise sold to women separate, so skirts, sweaters, shirts, and blouses, rather than the complete line of women's clothing that included dresses and coats. In 1976, the Limited opened its 100th store. The company grew throughout the 1980s by both creating divisions and acquiring businesses such as Lane Bryant, Victoria's Secret, and Abercrombie & Fitch. In 2017, Victoria's Secret opened its first store in Shanghai, China. And in 2020, Andrew Meslow became the CEO of L Brands.
Here we go over the business risk, the impact of March 2020 due to COVID-19, the closures of stores, and also within the separation of business plans to separate Victoria's Secret and Bath & Body Works by August 2020. There's a decline in the shopping malls, which consumers are now gravitating towards online shopping. The other risks involved with the Wexner-Epstein connection, the brand tarnished by its ties to Jeffrey Epstein, who once managed billions of dollars for Leslie Wexner, who is the L Brands founder. And then due to the Me Too movement, Victoria's Secret built a brand around male desire and sex appeal. The drivers of business, market, and operations. For the Victoria's Secrets, their turn in lingerie marketing into high fashion. Bath & Body Works reported high growth in hand sanitizer, soap, body care, and home fragrance sales this past year due to COVID-19. As far as the segmentation, March 2021, L Brands announced the new strategy to separate the two brands, as mentioned earlier, and Bath & Body Works will become their main business should this happen. Here we have a list of key competitors for L Brands. Competitors are Gap, Ross Stores, Nordstrom, and TJ Maxx. These are all public companies, and they have a retail presence in the mall and also as standalone stores. And as here you can see, the executive compensation on the number of shares for each of the executive members are based on the common stock that each individual holds, as you can see here.
Next, we have a summary of L Brand's most recent company call. The main points here are that most brick and mortar stores remain closed for the first half of 2020. Though not listed here, comparable sales were down this past year, but sales as a whole increased from 2019 to 2020. If we break down sales among segments, we see that Victoria's Secret actually saw an increase in sales after a rough 2019, while Bath & Body Works saw continued growth due to COVID. Also due to COVID-19, we saw a shift in some of L Brand's business strategies, the first being an increase in holding cash and current assets while trying to reduce current liabilities. We also saw a reduction in lease obligations due to COVID-19. These came in the form of store closures as well as lease negotiations with current landlords. These closures, however, were mostly Victoria's Secret stores, both domestically and internationally. Bath & Body Works actually opened new stores during 2020. L Brands also suspended their dividends for 2020 and stopped their stock repurchasing plan. This did, however, get reversed recently. Lastly, L Brands also announced that they made accounting adjustments due to the early extinguishment of outstanding notes paid. Next, we will look at a few key ratios from the past 2 years of the company's history. First, the current ratio, which has shown a major increase between the 2 years. This reflects the previously mentioned business strategy to increase liquidity for the time being. Also reflecting their new business strategy is the inventory to cash ratio, where we see a more than 50% decrease in the ratio, reflecting the change in inventory costs as well as their change in their liquidity. Continuing down, we see that the inventory turnover ratio has decreased as well, though this may be due to the company's efforts to reduce their cost of goods sold. We also see that a lot of ratios reflecting L Brand's strong year, including the price to earnings ratio, the earnings per share ratio, and the operating margin, all of which switched from being negative in 2019 to showing positive results in 2020. Lastly, we see that the price to sales ratio saw an increase, which is normally a negative thing. However, this may be due to an overcompensation of the retail industry as a whole in 2019. Shifting over now to horizontal analysis of L Brand's balance sheet. Few things here are the change in cash as previously mentioned, which has almost tripled from 2019 to 2020. Inventory, which has seen a steady decrease over the past few years, and also the recording of impairment of goodwill in 2019. On the liability end, we see that L Brands currently holds no short-term debt. As previously mentioned, they sought out to pay their outstanding notes payable. However, in exchange, the company did take on more long-term debt. Lastly, on the shareholders' equity side of things, we see that L Brands has accumulated a deficit for the past 3 years, though 2020 actually saw the significant reduction in that deficit. Moving over to the income side of things, a few points of interest here are the cost of goods sold, the increase in operating income, and a significant loss in miscellaneous income. It would appear that L Brands has committed to their strategy of minimizing the cost impact of the cost of goods sold, as they have shown a positive operating income despite the reduction in cost of goods sold. The loss under other income is related to the brand La Senza, a Canadian lingerie company that was sold, mentioned earlier. The loss incurred here relates to agreements as a part of the sale of that company. Lastly, a quick look at the vertical analysis shows a very similar story to the one previously painted. We can see the shift in the percentage of liabilities from other liabilities and lease obligations to long-term liabilities. We can also see just how much of an impact COVID had, with operating income being a mere 2% of revenue in 2019, and also the impact that 2020 had on the business, almost halving the deficit held in 2019.
Now we'll shift gears to looking at Nordstrom, which, as you know, is another fashion retailer serving multiple market segments. Its full-price stores carry premium brands in addition to its own Nordstrom lines and are known for offering excellent customer service. These stores sell apparel, shoes, cosmetics, and accessories for women, men, young adults, and children. Nordstrom Rack is the off-price retail division of Nordstrom Inc. and offers customers a wide selection of on-trend apparel, accessories, and shoes at a savings of up to 70% off regular prices. Nordstrom, initially a shoe store, was founded by John W. Nordstrom and Carl F. Wallen in Seattle in 1901. In 1928, Nordstrom handed down the shoe store to his sons. For most of its history, it's been a family business. The company went public in 1971, and the first Nordstrom Rack opened in 1973. Throughout the 1980s and 1990s, expansion of the now department store continued nationwide. In 2018, Nordstrom opened its first men's store. Finally, Eric Nordstrom became the CEO on March 3rd, 2020.
One of these main risks is sudden catastrophic events, such as the ongoing pandemic. Another risk is changing consumer taste, which may result in certain products being off trend or out of season. Also, general down periods in economic and market states may deter customers from having disposable income and money to spend. Also, fulfillment and shipment issues from suppliers, vendors, international production may cause from financial or environmental concerns. Another factor is failure for third-party brands to provide inventory as contracted. Lastly, legislation pertaining to production, taxation, and employment may change unfavorably and cause more financial hardships for the company.
Key competitors for Nordstrom are L Brands, Ross, Sephora, Gap, and Kohl's. These are all retail stores and are all public other than Sephora, that is subsidiary. All competitors are also valued at least $6.4 billion. So they're all doing very well financially. And they all also have some sort of presence on social media, such as Twitter. In comparison to Nordstrom's key competitors, we see that Nordstrom is valued the least out of all of them. So for the executive compensation structure, it's pretty low compared to that of L Brands if you compare the two. With L Brands, as we saw earlier, compensation varied greatly depending on the executive's position, whereas at Nordstrom, compensation was relatively close in relation to other executive salaries in the company. And here you can see also the stock awards, other compensation, fees earned or paid in cash, etc. For the drivers of business, market, and operations, one of the drivers is seasonality, meaning the weather, current fashion trends and fads, holiday-related spending, and things of that sort. We also have reputation with customers, vendors, and third-party partners. That's a driver. Mitigation of mishaps in supply chain via inventory management, adhering to customers' expectations in stores and online, and benefits program for loyal customers. And then for segmentation, Nordstrom is divided into Nordstrom and Nordstrom Rack stores, which cater to two different demographics. So Nordstrom Rack provides customers with bargain deals and less of a focus on customer experience and service, whereas Nordstrom provides customers with luxurious offerings, high focus on customer experience and service. For the summary of company earnings, the revenue was pretty high for 2020. And for the latest earnings, as we can see here, it's clear that net sales are 10,357 in millions and total revenues are 10,715 in millions. For key ratios, the ones that I wanted to focus on the most are the current ratio, the net profit margin ratio, and the return on equity ratio. So the current ratio estimates the ability of a company to pay back short-term obligations, and it indicates the higher capability of a company to pay back its debts. In this case, Nordstrom has a high ratio of 0.91. And this proves that Nordstrom really has a firm grip on its spending as well as its gains and can balance them out rather quickly. The net profit margin ratio indicates efficiency of a company at its ability to control the costs, which at Nordstrom is 3.19. And it shows us that since the company continues to improve year by year, Nordstrom has a clear idea of inventory costs as well as inventory demand and plans out the year accordingly. Lastly, the return on equity ratio is one that represents the amount of net income that's required as a percentage of shareholders' equity. And at Nordstrom, it's 50.66, which is fairly high and had also been increased since last year.
So here we can see the horizontal analysis of Nordstrom's balance sheet, and this allows us to compare the percent changes between 2019 and 2020, line by line. Generally, there appears to be a downward trend in the amount of assets and an upward trend in the amount of liabilities that Nordstrom takes on. This is not necessarily a bad thing. If we look closely at which liabilities are increasing, we can see that these are related to lease liabilities and deferred property and incentives. This is indicative of Nordstrom's gradual recovery from the circumstantial sales loss brought on by the 2019 pandemic, as it looks to finance and expand its brick and mortar presence. So basically, Nordstrom is continuing to invest in more stores. Continuing with our horizontal analysis, another important analysis that can help us observe Nordstrom's performance is the summary of net sales. This helps distinguish how much of the sales had come from Nordstrom itself and how much had come from Nordstrom Rack. We observed that there has been a decrease in total sales from 2019 and 2020 of around negative 46%. Although this may be objectively concerning, it's important to consider the temporary yet drastic impact of the pandemic on sales. Nordstrom stores have been closed to the public in the late part of 2019 and into 2020 at the height of the pandemic's impact. One positive statistic to look at is the increase in digital sales, as these have increased between 2019 and 2020. Land, property, and equipment make up about 43 to 50% of assets, which is an indication that, again, Nordstrom has a large brick and mortar presence. Operating lease right-of-use assets increased from 0 to 18% of total assets, and this indicates Nordstrom is in stages of acquiring, prepaying, and implementing new leases, which again goes with what I was saying about its expansion. In addition, there is a reduction of long-term debt between 2019 and 2020, which is a positive for Nordstrom's operating flexibility going forward, and it's also indicative that it's paying off its debts.
Most analysts recommended a buy rating for L Brands. Despite efforts to reinvigorate the Victoria's Secrets and Pink brands, the company failed to stabilize sales and profitability. And we expect growth that the brand should persist. Wall Street forecast the firm to chalk up returns and invest capital, including goodwill of 19% average through the fiscal 2030. But spending as a percentage of sales remains on the decline after 5% of sales in 5 years, ending of 2020, trailing other mall operators like Lululemon. As a result, the company has found itself lagging its peers when shifting to meet consumer shopping trends.
We surveyed industry analyst equity research reports from Argus, Credit Suisse, Morningstar, Reuters, and Schwab, among others. Most analysts recommended a hold rating for Nordstrom. Generally, Wall Street thinks Nordstrom continues to be a top operator in the competitive U.S. apparel market. The company has cultivated a loyal, affluent customer base on its reputation for differentiated product and service and has built an intangible brand asset. I believe Nordstrom has competitive advantages over other apparel retailers. For example, nearly all of its full-price stores are in desirable Class A malls or major urban centers. This is an advantage as lower-tier malls are unlikely to survive. Second, Nordstrom has a presence in discount retail with The Rack and significant e-commerce, 55% of its sales in 2020.
Our team reviewed the income statements, balance sheets, and cash flow statements for both Nordstrom and L Brands, as well as the vertical, horizontal analysis, key ratios, and Wall Street analyst forecasts. And based on all of these data, we've decided not to purchase Nordstrom or L Brands stock at this time. The question is, why not? Retail stocks have not performed well in the last year, including due to COVID-19. We have concerns about the future of brick-and-mortar retail as consumers have shifted to online purchasing. Demographic changes, millennial buying power increasing while baby boomer impact decreasing, and also the leisure wear trends have changed. The Me Too movement and focus on body positivity versus sexiness has affected styles. While earnings are expected to rise eventually, the short term is not rosy. Ratios are mixed, although L Brands is in a better recovery position than Nordstrom. Nordstrom downward trend in assets, upward trend in the amount of liabilities, current ratio of 0.9%, which is a good sign, net profit margin 3.19. Since the net profit margin indicates the efficiency of a company at its ability to control costs, this is worrisome. The earnings per share was also down 4.39. Return on equity is 50.66, which is fairly high and a positive indicator, but not enough to make us buy. Price to earning ratio is 29.19, which shows growth. L Brand sales for 2020 were up, especially Victoria's Secret and Bath & Body Works. Even with stores being closed for 6 months, they are holding more cash and reducing liabilities. The current ratio of 1.97, net profit margin of 7.12, which shows that the company is rebounding. If we were looking to buy and hold for the long term, possibly 5 years or more, we might have considered buying these stocks, but we're focusing on the short term. So despite some positive trending data points, we felt the other stocks offer better opportunity for higher returns.
Finally, although we are not compelled to buy stock in either company at this time, we still wanted to look further at lending to L Brand since it has the most economically sound growth potential. Of the two companies, L Brand has been keeping more cash and current assets on hand, and L Brand seems to have better offerings compared to Nordstrom. Nordstrom focuses on more luxurious brands, and for example, home goods and sanitation products from Bath and Body Works and loungewear from Victoria's Secret from L Brands can cater better to current stay-at-home consumer needs. Looking closer at the debt to equity ratio aspect, we would ideally want a figure of less than 0.05, which essentially means that less than half the company assets are financed by debt. So while L Brands in 2020 comes to a figure of 1.1, we know that this is a temporary circumstance due to the pandemic and that L Brands should continue to recover and expand, especially with Bath & Body Works getting momentum. Currently, L Brands is in recovery mode but has a lot of growth potential and prospects going into the future. So our proposal is to offer them a term loan that they can pay us back quarterly as the company continues to succeed. Thank you so much for listening to us, and we hope you enjoyed our presentation.